I'm Linda van Tilburg for Biznews, and with me is Mark Perchtold, founding director of OMBA Advisory and Investment, an investment-based firm based in London. Hi, Mark. How are you?
Hi, Linda. Fine and you. Thanks for having me.
Well, we've been watching the markets and what interest rates are doing, and I see there was a stark warning from JP Morgan Chase CEO Jamie Dimon that the Federal Reserve might not be finished with its aggressive regime of interest hikes and the fight against inflation. So, are we not peaking in global interest rates?
Well, Linda, it's a never-ending question, or feels like it over the last sort of 2 years. Is where will the Fed land up on interest rates? And without being too prescriptive, as economic data changes and as the world changes, one has to change their view. It does, in our view, seem like we're getting close to peak rates. Perhaps the Federal Reserve need to move another 25 or 50 bips, which I think would be a surprise to markets. That's not been fully priced in at the moment. We've come a long way from 0 to 25 bips range in interest rates, and the pass-through of that into the economy is slowly starting to take place in some areas of the market in terms of companies that are over-levered or households which are over-levered. Sentiment indicators and activity indicators, but the reality is in the US, the labor market is still very strong, and we saw job openings surprise to the upside yesterday, which then caused further jitters in bond markets as they think the Fed are likely to stay higher for longer. Whether they actually hike Fed funds rates more is a tricky one. I don't think they need to, but they could perhaps hold interest rates higher for longer, as opposed to earlier this year. Cuts were priced in that would be at 4% or lower by the end of next year, and that's already pushed upwards. So I think that there's a difference between the short end of the curve and Fed funds rates remaining high versus when they start cutting and the point at which we start seeing that drop. So I guess it's a tricky one. We're close to peak rates. Predicting the exact level is very difficult.
And you talked about the US. What about other parts of the world?
Yeah, I think across the globe, let's say broadly speaking, developed economies have been in a hiking cycle over the last 18 months because their inflation numbers have exceeded their targets, whether that's, looking at broader Europe and the ECB or the Bank of England in the UK, even the Bank of Japan have started to see inflation. But in other major economies like China, for example, they're actually cutting rates. Their inflation is very much in check, sort of hovering between the 2 and 3% mark. So China, for example, have room to continue cutting rates. We've seen a lot of developed economies begin a rate cutting cycle. So if you were to just simplify it broadly, large Western developed economies are at sort of peak or getting close to peak rates, maybe a few more hikes, TBD, we'll see, but certainly not cutting. Whereas in emerging markets, whether that's Latin America or places like some of the Southeast Asian countries, they've started to cut rates. So there's a bit of a bifurcation between the developed and emerging world in interest rates. So it's very difficult. Inflation is higher in some places than others. For example, in the UK, it's fortunately the last inflation print was better than expected, i.e. lower than expected, which is good news. But it can be stickier in certain economies. So countries with flexible labor forces, for example, where you can hire and fire more easily, like the US, don't have the labor sort of wage inflation pressure that some places like the UK would feel. So, if workers see higher inflation, they demand higher wages. And we spoke earlier before we started about, strikes relating to the train, and, Southwest trains that I catch every day is permanently on strike, it feels like. So, if labor unions are very powerful in an economy and inflation is there, they demand higher wages. And then that in itself can cause what's called a wage inflation spiral. I don't think that's likely, because the main drivers of inflation, if we go back to the sort of period of sort of late 2021, early 22, when inflation really started moving up, were pent-up savings from households, in developed economies that had received fiscal grants and, had been saving their money because they were locked down in COVID, coming out and saying, well, I've been saving all this money, I've been desperate to get out and spend it. And so we saw boosting consumption, demand for goods and services as households started to spend their savings. We've now seen a lot of the savings rates drop meaningfully. People have spent that money. And so that was one driver. Then coupled with that, you had supply chain issues around the world in the sort of post-COVID period, expensive shipping rates, logistical issues at ports. China still being in zero COVID for an extended period of time, China making lots of components that fed into, developed countries' manufacturing processes for, let's say, a new car. So we saw secondhand car sale prices spike because people couldn't get their secondhand cars. So we saw secondhand car prices spike, new cars not being made because components were coming from China, for example. So the second was really this disruption to the global supply chain. That's now abated to a meaningful degree, if not completely. And then we had the Russia-Ukraine war kickoff, which caused a spike in energy prices. And that confluence of the three things, pent-up savings being spent, which is on the demand side, supply issues due to supply chain bottlenecks, second pillar, and then the third being the spike in energy and other commodity prices, like some of the food commodities like wheat, for example. Those all drove inflation at the same time. And so the inflation spikes we saw, we don't think will persist. And we've started to see inflation numbers coming in. And so our view would be that inflation continues to come in, whether it's in 1 year, 18 months, or 2 years when we hit sort of central bank targets, very difficult to gauge. But the good news is it is coming in across the developed markets. And we could see, as we move into next year, potential rate cuts because inflation's coming in. The other side of that coin really is having had high rates now, this could trigger a recession in many developed countries. And if a recession is triggered, there's market disruption in various aspects of the market. Let's say, for example, the banking sector, which in Q1 this year started to see its the effects of higher interest rates, sort of a mismatch between the duration on fixed income within bank assets pools. If that sort of disruption occurs, the good news is that if you take the Fed, the ECB, or the Bank of England, they're at higher base rates now, so there's room for them to cut. Whereas post-GFC, in this zero rate or negative rate world, there was no more flexibility to drop base rates. So the stimulus was by other mechanisms like quantitative easing. And so I think we're in a good position in that central banks can act swiftly and in a coordinated manner if there is more extreme disruption. So inflation is very tricky to predict, but overall it is coming in, and we think the three pillars, sort of broadly speaking, that drove that inflation are all somewhat behind us.
So you mentioned China, that they are cutting interest rates. What about China? What do you expect there?
China's a very big topic in financial markets, depending on where you sit, and also geopolitically, of course. As I've discussed with Alec on prior interviews, we long-term like China from a strategic allocation point of view. We feel China's underrepresented in major indices due to its contribution to global GDP, its contribution to global GDP growth, the size of its population, its increasing urbanization. The scope for China to become a more developed economy is still there, and it's been out of favor because of its rise in terms of Western rhetoric and geopolitics. And the good news is, it trades cheaply. So a lot of the bad news is priced in. But we're reasonably optimistic on China. If you think of, its underperformance has created a valuation opportunity. It's the earnings of big Chinese, say internet and tech companies have been strong. Revenue growth has been strong. But they trade at on a broad index of internet companies in China on a 22 times multiple of earnings, whereas the US equivalents, US internet companies trade on a 34, 35 times earnings. So there's already a valuation discount there. And then you think about policy, a lot of policy announcements made towards, big platform businesses and tech, in the 2021-22 period from China caused a sell-off in those names. They've somewhat now stopped making big policy change and are supportive of these platform businesses, which are, part of their sort of intention as a government to improve the lives of their 1.4 billion people. Furthermore, we're seeing improvement on the geopolitical front. We've had, Blinken and Yellen and Raimondo, all, senior members of the US Congress visit China recently. Hopefully Xi and Biden will meet at the APEC summit coming up in San Francisco in November. So on the geopolitical front, the relationship between the US and China seems to be improving. It's far from at perfect state. But that's because, the West are somewhat threatened by China. China are leading in so many areas, whether that's battery technology and electric vehicles. And, they've got the greatest number of processing facilities for a number of the commodities that go into the clean, green energy revolution. They're leaders in battery technology, leaders in wind turbine assembly. They're selling their product now into the West because there's a demand from the West to become cleaner and greener. So, for varying reasons, we continue to like China, but it's a difficult market to own, given the constant negative rhetoric towards it. And as a percent, another on the negative side, only 4 or 5% of China is owned by foreigners, whereas in the US, comparative sake, that's 35% is owned by foreigners stock. So, it's not widely owned by non-Chinese investors, which in our view is somewhat positive, because if that moved from 5% ownership to 10% ownership, that would be good. They've also been opening up their capital markets. I mean, many people don't realize that, whether it's MSCI indices or it's, FTSE indices, they've all increased their China inclusion over the last few years as a part of that index, but still underrepresented if you think of it in terms of contribution to global GDP, size of their capital market. So, the scope for further inclusion is there, but they have already been increasing. The bond market, similarly, China's bond market, makes up now over 10% of the global aggregate bond index. That's happened in the last few years. Their currency markets have been opened up. You've got it's a Hong Kong Connect system, which connects, outside investors into mainland China and vice versa. So overall, capital market activity in China is increasing, and it's becoming more accessible. Yet we don't read about that in the press. So, we like China. We're cautious on our allocations. We're not going to be at 50% China, but overall we like it.
Marcus, what does this all mean? Should investors change their asset allocations now that there was a strong rally in view of what's happening in China?
Yeah, well, we've had the word rally is sort of from Q4 last year until maybe a couple months ago. We had a very strong rally, but that's somewhat abated in the last few weeks and months. And I think, part of it's a healthy correction. Markets maybe got a little bit ahead of themselves given uncertainty with high rates. And the way we've been thinking about it is as we go into a potentially slowing environment with, risk of recession, our base case would be in the US, we probably don't have a recession as defined, but there's certainly going to be a slowdown. So we've been thinking about valuations and where we want to allocate capital. And one of the changes we've made in our portfolios is to move some of our S&P 500 allocation into the S&P 500 equal weight. So the traditional S&P 500 is a market cap based index. So you end up owning more of the larger companies because they've got bigger capitalization, whereas the equal weight owns an equal share of all of them. And so by owning the equal weight, we're effectively underweighting some of the very large cap technology companies and communication services companies, which have rallied very hard. And, it's interesting, if you look at I think it was the 20-year anniversary of the equal weighted index on the S&P at the end of last year, it had actually outperformed the market cap based S&P by about 1.5%. So I think the numbers, if I stand to be corrected, but I think it was 11.5% annualized return on the S&P 500 equal weight over that 20-year period versus a 10% return on the market cap weight. But in recent years, the market cap index has significantly outperformed, driven by these large technology companies. And our view would be that, perhaps that corrects itself over the coming months and years. And inherently, by owning a lot of those equal weighted companies, that's more of the smaller companies in the equal weighted index, you own companies that often trade at more attractive multiples. So that's one of the changes in our US allocation. And the second, which we haven't yet initiated, is looking at the mid-cap names within the US stock market. So, you've got the S&P 400, for example, and again, mid-cap stocks over a 28-year period, if I'm correct on my exact numbers, outperformed the large cap stocks by 2%. And so, as we move into a different world where you've had this very strong bifurcation between your big, strong tech communication services winners and the rest, which have often performed poorly or flat, we think it might be an opportunity to rejig our allocation within the US. As pertains to other regions, we retain a slight overweight to China, as I touched on. Within Europe, we've positioned a little bit more defensively, moving some of our more cyclical sectors like European autos into European healthcare, which is a more defensive sector. And then another more recent trade that we've done in portfolios is if you followed clean energy stocks, which is a broader theme we like, taking a 5, 10, 20-year view on asset allocation. Wind and solar companies sitting within a clean energy ETF are appealing to us long term, but around the margin you can also tweak your weighting. And so given the sell-off we've seen in a lot of these names, driven by partly lithium ion prices rising massively, and also higher interest rates, we've seen a meaningful drop in the clean energy stocks and therefore the ETFs. And so we've started to increase our allocation to those as well. So those would be, the sort of more recent changes we've done in portfolios. But it's a very difficult time. We've got uncertainty on the horizon relating to the economy, uncertainty relating to how high interest rates go or for how long they stay elevated, and what the knock-on effects will be. So, it's not easy given we've had a good move up from Q4 last year already.
Well, you talked earlier about the influence of geopolitical attitudes, say, of the US versus China, and there might be a bit of a thawing there. There's still the Ukraine war. We've got a number of elections coming up. In the US, there's an election. There in 2024. In the UK, there's an election. In South Africa, there's an election. What is your sort of, that's almost like medium-term outlook on how those would affect markets, interest rates?
I think, forming a strong view on how policy will change post-election is very difficult in allocating capital. Firstly, you don't know who's going to win the election. That's problem number one. And then when whoever wins the election, knowing for sure which policies get passed, because often there's a requirement for coalition government, and it's very difficult to pass new legislation which might impact stock markets. But there are certain things you can look to, like in general, if you have a, Republican versus Democrat, House or Senate, what is the impact on markets? The Senate changes every 6 years, the House changes every 2. We've had big news overnight about McCarthy. So there's lots that can change very quickly. But normally what we would do is think more about, given the change, is there now an opportunity post-event? And so trying to read the likelihood of policy post-event, but predicting election outcomes is very, very difficult. And we wouldn't make broad-based allocations based on sometimes guesswork on how the election pans out. But it's a catalyst for activity. So we trade around our drivers of investing are, valuations and where we are in cycle, but then monetary policy, fiscal policy, and certainly fiscal policies linked closely to governments. Monetary policy is supposed to be independent of the government, but monetary policy and fiscal policy are very important. And then geopolitical sentiment, the Trump period in terms of his anti-China rhetoric presented opportunity to some degree in allocations to China, which then rallied. We're now still in a period of uncertainty as to how geopolitics unfolds with China. So, that's just one example, whether we're looking also at Brazil and how, policy change there, following a change of leadership could impact longer term the stock market, and Brazil's relationship with China and the new BRICS Plus setup. So, we're aware of all of these things, but you've got to think very big picture geopolitically and macroeconomically as to how it might change. And sometimes people just guess. And we don't like to guess. We'd rather have some level of certainty and then balance risks carefully.
That makes sense. Thank you so much, Mark Perchtold from OMBA. Thanks for speaking to us, and sorry about the technical difficulties we were having.
No problem. Thanks, Linda.